Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list. Questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at therogueagent.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet unqualified to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. With an IUL, how do the caps on index gains impact my cash value compared to what I'd get with a whole life policy's fixed rates? So the cap rates on IUL basically represent the upper limit of what you can earn in the IUL contract. So an insurance company buys and sells a call option on the S&P 500. This creates a spread, what they call a bull call spread. So the amount of the spread represents the maximum you can make in the contract at that cap rate. So if the insurance company buys in the money call option, if you're familiar with how stock options work, they buy in the call option on the S&P 500, which is very expensive because options prices are constantly fluctuating, and the more demand there is for an option, of course, the price gets bid up, and then also you have changes in price based on implied volatility and expiration dates and how far in the money it goes, and so on and so forth. And just so the prices are always changing, but I can tell you that over time, the S&P 500, the index options have gotten, they're not like too expensive to buy, obviously, but they've gotten more expensive. And then the company does that, and then they also sell a call option at a strike that is, maybe 10%, it could be 8%, could be, 5%, depends on what the cap rate is, but they said, say 10% above the call option that it just purchased. And if they did it 10% above the short call the long call that they bought, then this would translate into a 10% cap on the earnings for the year in the IUL. So depending on the price action of the S&P that year, you might make anywhere between 0 and 10%. So, returns can vary a lot year by year. And then, of course, you also have to figure in theta decay and some other issues around options like won't go into here. But basically, your options contract, anytime you buy an options contract, you go long, they say, on an options contract, you have to deal with the fact that option is decaying. The value of that option is decaying. You're losing extrinsic value with every passing day. So you have to really do a really good job, and carriers they don't want to deal with that because that eats into profit. So they kind of want to buy in the money, and that, they're still losing extrinsic value, but they're, hopefully intrinsic value makes up for that. And so they have to, they have to get their purchases right. They can't, totally remove that risk, but they're, the policyholder doesn't see that risk either. But, they have to buy those options and hope that the S&P moves up, fast enough that they capture enough of the gain. So you can have the S&P 500 go up 10% and still maybe you didn't quite get 10%. Maybe you got, 8% or, 7 or something like that. It could be just from the value of the option, what the value of the option did at that, during the year. The benefit of doing things that way is that the losses are going to be capped at 0% due to the fact that the losses are limited with a bull call spread. And also the insurance company has invested most of your premium in guaranteed bonds. So that's just by default, that's risking just a small amount on the options themselves. So this is why the insurance company can offer a 0% floor. Some do offer like a negative. I've seen that more in VULs, variable life products. But, the insurance company can offer a 0% floor. That's for performance-wise, right? That's for performance in the S&P. So the trade-off is that the gains are also capped by the call spread. So with a dividend-paying whole life insurance, you're not participating in the price action of a stock index. You are participating in the performance of the insurance company. Its business, from life insurance, from term insurance, other insurance sales, to the investments in its general account, to its ability to cut costs and control mortality expenses, you're benefiting from profits and savings in all areas of their business. So when a company does well, you do well. And when the company doesn't do well, you don't do as well. And those losses in the whole life are capped at the guaranteed rate. So you don't ever make less than whatever their published guaranteed rate is. That's your floor. The gains are essentially uncapped as however well the insurance company can do it. So dependent entirely on the performance of the company. So dividends tend to be fairly stable. And over time, we hope that they go up. But you very rarely do you see dividends, shoot up and then come back down again. They tend to remain fairly stable for a couple years at a time. Companies that sell participating whole life tend to be more conservative, right? So they don't like to change the dividend much from year to year. They don't want it to be like an investment. They don't want it to be this thing where it's the dividend rate 7% one year, then it's 10, then it's 4, then it's 5, then it's 6, then it's 10, then it's 7. That's too jittery. It makes policyholders nervous, especially if you have to go from a 10% rate down to let's say a 7 or 6 or whatever percent rate. That's a big drop. And people buy whole life insurance because it's stable. That's the thing that insurance companies can offer. That's what they're selling. You say, hey, if you don't like all this volatility, come to us. We have a product that is very stable. It's not the dividends themselves. We can't guarantee a specific dividend payout, but the product is stable. We give you a guaranteed rate, and even though the dividends themselves aren't guaranteed, we're going to try to keep these dividends stable, and they're going to have a stable dividend. And once we pay the dividend, by the way, that becomes part of your guaranteed rate, right? Guaranteed cash value. So they're trying to be more conservative and offer as many guarantees as they can. Performance-wise, index life insurance, the goal with IUL is to beat whole life insurance, but to do so, it's takes more risk. Just in the way that it generates interest credit. So this risk is tied up in the call options, which could expire worthless. A lot of call options expire worthless. So the likelihood with an IUL is that you will do very well or very poorly in any given year. And with whole life insurance, the likelihood is that your policy is going to perform very consistently from year to year. And you're not going to see huge swings in interest credits. Anything can happen, but the odds are against it. With an IUL, the odds are in favor of wild swings in crediting rates from year to year. The hope is that in spite of those volatile crediting rates, that you'll outperform whole life over the long run. In reality, what tends to happen, and again, it doesn't happen with every IUL, but what tends to happen is that it performs very well off the line, and then performance starts to drag a bit as the policy ages. So some of this is due to the options pricing becoming more expensive over time, which isn't reflected in the illustration. The dynamic options pricing, it never gets calculated into the illustration. They just assume a flat crediting rate. It's sometimes the insurance company, you get variability in crediting rates. Sometimes because the insurance company just retires an old product, drops the cap rate on that old product, and then introduces a new product, and then gives the higher cap rate to the new product and new policyholders. I've seen that firsthand. It happened to policyholders. I shouldn't name the company maybe, but it's happened to new policyholders. And by the way, that company's still around. And they just then nobody talks about it anymore. And I've met policyholders. I used to sell policies for them before, back when I first started in the business, I sold policies for this company when it was under a different name. I've met policyholders that were not mine who said, yeah, I'm sitting here stapled down to the 4% guarantee. And some of the really old ones are down to 2%. So nobody talks about that. Those policies, by the way, are about 22 years old now.
So, I mean, I've seen that firsthand, and you're not going to hear from 20 years, some whatever odd years, policyholders that are 20 years into their policy talking about this. They're either sold their policy or they're disgruntled, or they're too embarrassed to talk about it. Old policyholders end up subsidizing new ones, though. This doesn't really happen in whole life insurance because each whole life block is essentially self-contained. And the block is, so the way that those work is that the block internally has to be profitable. And the company's not really incentivized to try to hose policyholders. They're trying to pay dividends meritoriously, and so the more premium that you pay into the insurance company, into divisible surplus, the more dividends you get back. That's how it's structured. And they're not subsidizing old business with new business. It's not how the product works. And so the performance of the block determines the dividends earned for policyholders in that block. And the money can't be diverted elsewhere. Plus, the mutual companies that manage these blocks have a reputation for not hosing their policyholders. So IUL theoretically can outperform whole life insurance, but in practice tends to perform very similarly to whole life or to like a current assumption UL product, like a fixed UL. Maybe it earns 50 to 75 basis points higher than a traditional UL over the long term, but it's not going to perform like a mutual fund, like you would find like a high, like a high volatility mutual fund or a high volatility equity of some kind. That's just not what it's designed for. Now, do some IULs have really stellar crediting years? Yeah, they do. I mean, you can find crediting rates where, like, there's been years where maybe the IUL did 10%, maybe 12%. If it had let's say it had a 12% cap, maybe it hit the cap, but it's not doing that every year. So it's supposed to give you some upside potential with, no downside risk. And there's a market for that. Some people like that. It also comes with all the risks that you normally get with a universal life chassis, and you have to be accepting of that. You have to be okay with taking on those additional risks. And if you're not, don't buy UL. Don't buy a UL chassis. If you don't like the risks that are inherent in a universal life policy, do not buy a UL policy. Buy something else. The crediting rate is not going to overcome the inherent risks in the chassis of the product. It's just a different way of crediting interest to the cash values. So you can have lots of different ways. You can have sub-accounts, that'd be variable life. You can have index credits, that would be index life. You can have the general account portfolio, current interest, new money rates, or whatever. It's current assumption UL. So you have different, UL is just the chassis, and then they bolt on like different ways that you can earn interest in the cash surrender value. But the underlying chassis is always going to have the same risks, the same inherent risks of just because it has no guaranteed level premium. The mortality expenses do have a guaranteed upper limit, but the expenses are essentially variable. They're not guaranteed and fixed. And so they can vary like up and down, and the crediting rates vary up and down. And so because you only have a planned premium and not a guaranteed level premium in a UL policy, you just have to be accepting of the risk that presents over time and what could happen. So that's it. I mean, that's how they work. So anyway, the cap rates, that's how the cap rates work. And anyway, I hope that helps. And we'll see you in the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to therogueagent.com and sign up for my daily email list.